It's 1:30 p.m. and it's Monday. Thank God it's a new week. It's time for you to get updates from the world of business here on Business Incorporated. I'm Ini John Bekwan. We begin with wheat prices. It has surged globally. And of course, that follows Russia pulling out of the grain deal. And Nigeria's inflation also surges. Food inflation now is at 25.25%, and that's for June. And Kenya remittances jump. Good afternoon. Welcome to Business Incorporated. Once again, I'm Ini John Mekwa. We start as usual with the market numbers. It's a good thing for the NGX this afternoon, recovering from those 3 days of losses that it recorded last week. The NGX as intraday getting really close to 63,000 points after gaining 0.54%. That's at intraday. Hopefully, it will hit 63,000 at the close of trade. South Africa is, however, on the flip side, almost 1% down, 0.73% at intraday. Egypt is positive, 1.70%, and Kenya closed Friday's trading in the negative, 0.24% down. Move to the Middle East now, where it's mostly positive for the market there. Abu Dhabi is negative 0.10%. Dubai is, however, positive 0.11%. Saudi Arabia is also positive 0.33%. Qatar also more than 0.5% in the green, 0.54% at intraday. Well, let's go to the big story. One of the big stories of today, Russia has halted its participation in the Black Sea grain export deal. The Kremlin made this known today, and that, of course, has sent the prices of wheat high in globally. Well, the deal brokered by the United Nations and Turkey last July aimed to alleviate a global food crisis by allowing Ukrainian grain to be safely exported amid Moscow's war in Ukraine. It had been extended several times. In fact, supposed to mark a year this month, but expires today. And Russia had been saying for months that conditions for its own export has not been favorable, and so it will not participate in an extension. The Kremlin said that the deal has de facto ended. It comes as Russia accused Ukraine of attacking the Kremlin's bridge overnight with maritime drones, killing 2 people. The deal has sent wheat prices surging, with the Chicago Board of Trade most active contracts up 6.7% at about $689 a bushel. And the deal was set to expire at the end of today. I wonder what this will do to Nigeria. In the coming days, we'll see all those wheat-related consumables will certainly be affected. But let's stay over there in Europe and see how reactions are trailing this. And joining us for this conversation is Cassandra. Cassandra joins us from Berlin. Hi, Cassandra. Good afternoon. So it was this way or not, and now the Kremlin has come out with its position, and it seems there's nothing we can do to change it, at least for now.
Thanks for having me. Yes, this is a pact that allows the safe export of grain from Ukraine via the Black Sea. It's been in place for the last year, but if Russia does not agree to extend it, the deal could fall apart. Now, Russia has agreed 3 times in the past year to extensions of the deal, but there was also a brief suspension of its participation at the end of October in response to a drone attack on its fleet in Crimea. So at the moment, Russia is threatening to quit the pact because it says its demands to improve its own grain and fertilizer exports have not been met. Russian exports of food and fertilizer, by the way, are not subject to Western sanctions, but there are restrictions and limitations on payments, logistics, and insurance, and Moscow is saying these amount to barriers to shipment. Russia is also complaining that not enough grain is reaching poor countries from the deal. The United Nations disputes that, by the way, Norway, saying the arrangement has benefited poorer states by keeping food prices at least 20% lower globally. But news of an attack on a bridge linking Russia to Crimea is sparking comments from Russian politicians who say this is just another reason not to renew the grain deal, though the Kremlin itself has not commented on the Crimean bridge incident's implications for the grain deal.
But obviously, this was a very necessary deal for not just the two countries, but other countries. So what can we expect as it's not being renewed?
Both Russia and Ukraine are some of the world's top grain exporters. And under the deal, nearly 33 million metric tons of corn, wheat, and other grains have been safely exported from Ukraine. We talked about that figure from the UN a moment ago, but the UN has also pointed to how far-reaching these exports are. Just the wheat from this deal has reached 45 countries. 46% of it went to Asia, 40% to Western Europe, and 12% to Africa. These are really critical supply chains. And the UN says that its World Food Program depends on wheat from Ukraine, with 80% of its wheat so far this year coming from Ukraine.
So now let's look at the markets now, whether how that's moving, which way or the other for the markets.
As markets continue to open around the world, they will be sure to cast a wary eye at weak economic data out of China. The Chinese economy grew at a frail pace in the second quarter of this year, with post-COVID momentum faltering, and that's putting pressure on policymakers there to deliver more stimulus. So far, Asian markets have struggled to build on a rally from last week, with that news out of China really taking the wind out of their sails. But after some positive inflation news in the U.S., investors will begin to weigh whether they think the news was good enough for the Federal Reserve to start to wind down its monetary tightening drive. That's the one that's been in place, raising interest rates for the last year.
All right. Thank you so much, Cassandra, for bringing us up to date on that. All right, let's move over to London now, where, more conversations going on. I think one of it is going to be with the supermarket bosses to meet and talk about petrol price concerns, which of course will affect everyone, affect prices and all the staple foods that are being consumed. There we have our correspondent Juliana joining us. Hi, Juliana. Good afternoon. So this meeting is obviously going to be connected to price one way or the other if we're talking about petrol price concerns.
Yeah, that's absolutely right. Good afternoon, Innie. The cost of living crisis and discourse around it is going absolutely nowhere in Britain, particularly because we had GDP data for the month of May, last week, showing that GDP had dipped. So it's of serious concern to the UK government, which is why, as you said, the Energy Secretary Grant Shapps will be having a meeting today with top bosses from the big four supermarkets here in the UK. So that's Sainsbury's, Asda, Morrison's and Tesco, as well as with XX from Shell, BP and ExxonMobil, to really have a look at petrol prices and to find out what these groups can do to make sure they're not profiteering off the back of consumers who are really struggling at the moment, particularly because, of course, we've got high inflation rates, but also then high interest rates are putting mortgage holders on the brink. There was a report released by the Competition and Markets Authority last week that actually showed that during 2021 and 2022, British car users were charged an extra £900 million during that period. And that was, of course, because of the war in Ukraine and the fact that petrol prices were pushed up. Of course, we know they've since fallen from that peak. So I believe that part of the meeting that Grant Shapps is going to be having with these bosses is just to find out why these price drops are not trickling down to consumers. I do believe as well that the CMA, the regulator overseeing competition, is wanting to launch some sort of scheme by the end of the summer. And the British government are trying to nudge, shall we say, supermarket bosses as well as these big execs from the oil and gas community to sign up to this voluntary scheme, which will basically put live pricing data on applications and on websites so that consumers can pick and choose exactly where they want to buy their petrol, and it can help ease the cost of living crisis that we're currently going through.
Yeah, we hope that. But I don't know about ease for train drivers union, who are saying they're banning working overtime for a third time. I thought they want to work overtime to earn more. And of course, this is going to disrupt the whole schedule for railways.
It is more disruption, unfortunately, for beleaguered Brits. We've been going through industrial action for several months. In fact, last week we hoped perhaps there could have been some breakthrough between talks, because Rishi Sunak, the Prime Minister, did announce once and for all that there would be a 6% pay rise for NHS staff. Unfortunately, that's not trickled in terms of that goodwill sentiment into other sectors. So we did hear from ASLEF Union, which does represent a proportion of train drivers in the UK, and they are going to effectively not do or conduct any overtime between, I believe, July the 31st and the 4th of August. Those periods are of a particular interest of parents, because, of course, anybody that's not getting out of the country for summer would like to travel across the country. And unfortunately, that's going to be made particularly difficult. As you said, people generally do overtime because they want to earn more money. But within the rail industry, that's been going through significant issues because of COVID and the fact that people's work schedules have changed. Believe it or not, not the vast majority, but a lot of people enjoy working from home. And of course, train operators get their revenue from ticket prices. There's big issues there. Lots of...
Go ahead, Juliana, I can hear you.
Apologies, I'm having a bit of audio interference there. But yes, so that's the ASLEF Union strike, which is going to be taking place shortly. It is coupled with an RMT strike, which is the Rail Maritime Transport Union. They're also going to be striking, I believe, on Thursday and Saturday. That is going to affect Brits trying to get across the country. And again, this is all about pay, working conditions. Train drivers in particular say they haven't been able to sit down with the government for 6 months. They've not spoken to train bosses for about 3 months. There is a 4% pay offer on the table. They say that is not enough. So yes, more industrial action continues at a time where people were hoping to have pretty relaxing, stress-free summer holiday.
Yeah, well, unfortunately, we hope they can resolve it. But let's look at the markets now. How's it looking?
Yeah, not bad. At intraday, the FTSE All-Share is down slightly by 0.30%. The FTSE 100, that's down by 0.27%. And the FTSE 250, the domestic market, that's down at 0.47% at intraday. In the currencies market, the British pound is currently trading up against the US dollar, down, shall I say, by 0.09%, down to against the euro by 0.13%, and down against the Japanese yen by 0.45%. Though it's not been reflected in the markets, probably worth mentioning mortgage rates. 2-year mortgage rates last week hit, I believe, a 9-year high of 6.63%. That's since come down, which is really good news, because we know that mortgage holders in the UK are currently paying between £250 and £400 a month extra on their mortgage repayment. So the fact that that's gone down is good news. I'm sure that will trickle at the markets before close of play. All right, so we're looking out for it. Most will see it tomorrow. Thank you so much, Juliana. It's Business Incorporated and not Business Morning. Welcome back. Well, now we start from Nigeria. In June, inflation is out. The headline inflation rate rose to 22.79% relative to May 2023 headline inflation, which was at 22.41%. And looking at the movement, the June 2023 headline inflation rate showed an increase of 0.38% point when compared to May 2023 headline inflation. On a year-on-year basis, the headline inflation rate was 4.19% points higher than when compared to the rate recorded in June 2022, which was 18.60. Well, this shows that headline inflation rate year-on-year has increased in June when compared to the same month in the preceding
year. That, of course, is June 2022. Now, looking at food inflation, that has hit 25.25% on a year-on-year basis. This was 4.65% higher relative to the rate recorded the same time last year when it was 20.60. The rise in food inflation on a year-on-year basis was caused by increases in prices for oil and fat, bread and cereals, fish, potatoes, yam, and other tubers, fruit, meat, vegetable, milk, cheese, and eggs. And on a month-on-month basis, the food inflation rate in June was 2.40% higher. This was a 0.21 percent point higher compared to May 2023, when it was at 2.19%. Wondering what that will look like now that the grain deal is off, and we know how much import Nigeria brings into the country, wheat, grains, and all of that. Now to other issues now. Nigeria's biggest lender is seeking more acquisition in a bid to expand outside its home market. That's Access Bank. We had the story from Friday. For today, we're just going to discuss what it means and some updates on it. Access Bank PLC last week announced the purchase of the British giant's entire operations in Angola, Cameroon, Gambia, Sierra Leone, countries where it's already present. Then the Lagos-based lender is also taking over Standard Chartered's consumer, private, and business banking division in Tanzania, widening its footprint to at least 17 markets. I wonder what this means from both sides, both Standard Chartered and for Access Bank. Well, to help us understand some of those details is Mr. Mohammed Mukhtar, the Chief Executive Officer of Finance with Mukhtar. Mr. Mukhtar, thank you so much for your time, creating time from the United States. Good afternoon, or good morning to you there. Good afternoon to us here in Nigeria.
Definitely good morning here and good afternoon there.
Yeah, so what does this mean? Of course, it should be good news for Access Bank, but what does it mean for Standard Chartered? Are they reducing their exposure to some African countries? Is that what it means?
Well, that's what it means. They've said it before now. They were about to reduce their exposure in other African countries. And part of it was Sub-Saharan Africa, and most of the branches that they've just sold to Access Bank also were part of it, what they were looking. They were not looking at reducing their because of profitability or not. They were looking at in terms of how to reduce their overhead costs in terms of network all over Africa. And they were looking at some of the countries that had not been easy for them to integrate into other countries. So definitely for them, it's good news. They're able to get this off their back, and so that they can concentrate in other African countries that they are, like they're still in South Africa, and they are also still in Nigeria through Stanbic IBTC. So definitely it's a good move for them, because they've been looking towards how to sell this subsidiary in these countries.
Well, isn't this going to send like a bad signal to some other, multinationals to say, oh, Sub-Saharan Africa, perhaps there's something wrong going on somewhere. Should we also start reducing our exposure?
Well, it depends on what your business strategies are. Like I said, Standard Chartered is all about corporate businesses and corporate giants, and they have looked at, they are not so much into consumer banking, or mostly they do private banking. And so when you look at these countries that they've exited from, in terms of if you're trying to do consumer banking, those are good cities to look at, to be in. If you're trying to do retail banking, those are good places to be in. But if you're looking at private banking, then you need to look at major countries in Africa. And when you look at the countries they've exited from, you look at Cameroon, Sierra Leone, the Gambia. In terms of private banking, those places are not the best of places to be. And also, the only place that you could say, okay, maybe it could be better a little, would have been Angola, because of their oil producing nature. But again, that has to do with the economy, and they are looking at private citizens. So that also may not work for them. So I think it's all about synergy. Other banks will look at it and say it's a good time to go into those places. When you look at the consumer space, the expansion in terms, and the economy of those nations are still very, 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 very young, with a lot of opportunity for more growth in areas of consumer, like I say, and retail banking.
All right, thank you so much, Mr. Mukhtar. I'm sure in the coming days we'll see the impact it will have on the share prices of Access Bank, and see if more people will be attracted. But thank you for your time this morning to your end.
Thank you. Have a good.
You too. All right, moving on to other stories now. Just before we go, Anglo-Dutch super major Shell signed a long-term liquefied natural gas supply agreement with Morocco. This, according to the country's energy ministry, involves the supply of 6 billion cubic meters of LNG over a 12-year contract period, while the agreement calls for 500 million cubic meters per annum of gas supply. The two companies did not disclose the potential valuation of the supply agreements. And then we're back to Kenya now, where there was a 6.1% increase from $326.1 million. That's about 46.1 billion shillings in the remittances during a period in June 2022. The Central Bank of Kenya, the CBK, notes that the inflows supported the current accounts and the foreign exchange market. The U.S. remained the largest source of remittances to Kenya, accounting for 54% in the month of June 2023. And this followed the continued depreciation of the Kenya shilling, which hit an all-time low of 141 shillings per unit of the United States. CBK data show that the shilling traded at 141.29 shillings per unit for $1 on Thursday, and compared to 117 per unit in June 2022. So it might not really be an increase. It might just be because of the depreciation of the value of the shillings that we have. That's still staying in Kenya. The ratio of bad debts at Kenya's lenders may climb by 100 to 200 basis points by the end of the third quarter amid delayed government payment and a challenging economic environment. And that's according to EFG Hermes. The local banking industry's non-performing loans as a share of total assets has stayed above 10% for the last 6 years, soaring to 14.9% last month. That is higher than markets such as Nigeria and Pakistan. And Gadha, the director of Frontier Banks at the Cairo-based, made this observation. That's where we close for Business Incorporated this Monday afternoon. Thank you so much for being a part of it. We'll do it again tomorrow. I'm Ini John Mekwa. Enjoy the rest of your day.